All right, good morning, everyone, and happy Thursday. We are a week out from Christmas, and so happy holidays to everyone. We have a great topic today, talking about approaching retirement, which I'm very excited to share. The presentation should run about 30 to 45 minutes, hopefully, and then we'll answer some questions after that. So let me share my screen and give you guys a quick little introduction. Um, so, my name is Jack Manzanotti. I am one of the certified financial professionals with Everhart. We have quite a few CFPs on staff, and we go out and we help a lot of our plan clients help retire. And so today we're going to be talking about steps that we usually work with our individual clients on to help them prepare uh, for this big day, right? So if you're in that scenario, if you are in your 50s or 60s thinking about retirement, I think we're going to have a lot of valuable information for you today. There is a hand raised, so I don't know if there's any questions in the meantime. Usually, I start out with saying this presentation is recorded. These slides will be sent out to you the next day. And so I will answer questions periodically as we go. But also, if you do have questions, feel free to write them in the chat box here. So, approaching retirement, let's get it kickstarted. So there's a lot of things to think of when you are about to retire. There's a lot of different dates in mind that people are concerned about. And a lot of it revolves around Social Security, when you can access your retirement accounts, Medicare, you name it. There's all these rules that the government has put in place. Some make sense, some maybe don't make as much sense as we would like them to. But here's just a timeline of things that you should consider. So starting at age 55, this is when you first can withdraw from your 401k assets. Most people think it's 59 and a half. However, you can withdraw it at age 55 without any penalty, as long as you keep your retirement assets inside of the 401k. Now, if you move your 401k to an IRA, like a lot of people do, that's when you have the rule 59 and a half is technically when you can withdraw from those tax deferred assets without incurring any penalty to that. So those are important dates on when you can access your retirement money. Now, at age 62, this is where it gets a little exciting. This is the first date you can actually access Social Security. So you can access Social Security and take it. However, you will get a reduction in your Social Security amount. Okay. So they say, well, you can take it, but at the end of the day, you get a little reduction there. Age 65, you qualify for Medicare. So a lot of people target age 65 as a date they'd want to retire because you get great health benefits. Of course, there's a little cost depending on your income, but that's when you can get really quality health care at an affordable coverage. Um, then 66 and 67, between these two dates, that's when you get your full Social Security benefit. Um, that's not your maximum benefit, but that's when the IRS says, well, you can get your full benefit without having a reduction to your Social Security. So we'll talk a little bit about what that looks like. But if you wait till you're 70, you actually get a 24% increase in your Social Security. So that's when you max out. So don't wait any longer than age 70 to take Social Security. There's no reason to wait any longer. If you are 70 right now and on this, please take Social Security. And then at age 73, there's these things called required minimum distributions. So the IRS says, well, you have to take money out of your pre-tax accounts starting at age 73. However, that age is going to move to 75 if you were born in 1960 or later. So if you have pre-tax accounts in your IRAs or 401ks, that's where you do have to take a little bit out starting at age 73. But for most people on this call, it's probably going to be age 75. Um, so usually when we sit down with a client or a couple, we're talking about these age ranges. But I would say ultimately a lot of these ages shouldn't dictate your retirement in a way, right? If you can retire comfortably, if you have enough retirement assets already saved up, in a lot of cases, don't let Medicare at 65 keep you working. If you can retire at age 62 and live comfortably, there's other ways to get health insurance, quality health insurance. You don't have to wait till 65 to get going. I know I've met with I had various new clients this year that were under the impression that they were probably going to wait till age 67 to retire. And they're 60 right now, but we ran some projections and they're likely going to be able to retire at 63. So there's a lot of cases where you can run through these scenarios and determine that you can retire earlier. And then there's going to be some times when you're going to realize that you might have to work a little bit longer, depending on your circumstances. So lots of dates in mind, and then keep in mind the government, these ages sometimes tend to fluctuate, so they don't always stay the same. For instance, the RMD age was 70 and a half a couple of years ago, and then it was 72. So these tend to change over time. They don't tend to stay static. So proactive planning. Proactive is very important here, where our goal for a lot of people that we work with is to run these retirement projections, run retirement plan projections. On the right-hand side, you'll see that is one of the kind of the pillars that we work with. However, in order to run retirement projections and do effective planning, we have to focus on identifying your income. One of the first things that we do. So if somebody comes into our office and is like, "Hey, Jack, can we retire?" Well, that's a fully loaded question there, and we kind of have to dive through some of the details at first. And the first thing that we want to do, okay, let's identify all the sources of income. What's your Social Security going to look like? We can hop on SSA.gov and get those projections. We need to look at your retirement accounts. What do you have saved up so far? Do you continue to work in retirement, at least maybe part-time? Do you expect an inheritance? So there's various things that we look at when you have income in retirement. The next thing is figuring out an estimated budget. What are your expenses going to be? And I'll tell you what, nobody knows what their expenses will be in retirement, or at least, have they often underestimate what their expenses might be. So it's important to get out pen and paper, to go through your budget, to figure out what your expenses will be. And I get it, it can be hard because in retirement, maybe you pay off your mortgage. Calculating your budget in retirement is just takes time, and most people don't know how much they spend, so it's just an important process to do. And then the third thing would be inside of your investment accounts, reviewing the allocations. How much risk do you have? Are there any areas that your accounts could be optimized? What are the fees that you're paying inside of those IRAs or 401ks? So reviewing your investments, of course, is a big part of the planning. So doing those first three things, identifying income, reviewing your budget, analyzing your investments, all lead up to running a very efficient retirement projection. So this is something, of course, all of you guys are our clients basically of Everhart. We probably manage your company's 401k plan. Reach out to your workplace advisor, whether it's Max or Clark or Phil or John or myself. We'd be happy to run through some of these projections, although it does take data, right? We do need to kind of flesh out your entire financial picture before we do that. The other very important piece, don't want to forget about this, is how long are you going to live, right? If we knew that, we could help you plan for retirement probably better than anyone. The life expectancy thing here is sometimes hard to narrow down, but it's obviously an extremely important part of your financial plan and retirement projections. So oftentimes we're in conversations where we're asking people, well, how long did your parents live? How's your health right now? And those sometimes are tougher questions to answer and ask, but it's a very important piece of the pie, because if you're only, maybe expecting to live into your late 70s, early 80s, maybe you can afford to spend more money and take more trips and have a really solid retirement. Now, if you've got really long longevity in your family, and you're gonna, everyone's living until their 90s, and you want to retire at 60, and your retirement's gonna be 35 plus years, well, you need to be maybe a little bit more conservative. So, um, healthcare is a big deal. And I like just to point out on this chart, if you are a couple right now, if you're 65 years old, say you're married, about a 50% chance, you'll see it in green if you look at 90 years old, there's a 50% chance that one of you is likely going to make it till you're 90. So healthcare is getting better. We're living longer. So just plan accordingly when it comes down to that. So money coming in. When you're evaluating how much money, how much income you're going to have in retirement, well, it kind of comes down to these five areas. Your Social Security is a large part of retirement planning, and it depends. It's a very complex calculation that the government uses to calculate your Social Security benefit. But Social Security does provide usually a substantial amount for people's retirement, of course. So go to ssa.gov. You can figure out your estimate there. It's good to see if you are in your 50s, just good to see what the amounts would be at, your full age of retirement at 67 or potentially at 62, and kind of vary that out. The next thing is your investments. So if you have hundreds of thousands of dollars, usually there's a withdrawal rate that you can withdraw and have your investments sustain, and so you don't deplete them. So there's calculations that you can do there to determine how much income your investments can generate. Um, we use a rule, usually the 5% rule. So you could take 5% of your savings and live off that very, very comfortably and not deplete your savings over time. So we'll talk about the 5% rule in a little bit. If you have any rental properties, sometimes you might have rental income. Part-time employment is becoming increasingly more popular with the way the cost of living is. Things are very expensive. And a lot of times, most people just want to have something to do in retirement. They might be bored, so they might pick up work at the local grocery store, or they might pick up some part-time work at the golf course, doing something that they like that isn't too time consuming, but does provide a little bit of income there. So there might be part-time income that might factor into, your retirement. And then inheritance, which can be a touchy subject. Oftentimes, a lot of times parents, maybe in their 80s or 90s, don't like to talk about money, but it could be in a very important calculation in your retirement picture of the money coming in to see if there's any inheritance there. Now, money going out, again, budgeting for your expenses is extremely difficult. There are a few things that we do typically know going into retirement. Your expenses typically will drop. And just looking at expenses that we know that will automatically be eliminated, there's definitely two in mind. Your savings into your 401k or IRA or brokerage account, your savings total, of course, that's going away. And then your payroll taxes. So each and every time you get a paycheck, you pay a lot of money into what we call FICA, right? The Federal Insurance Contribution Act, which consists of Social Security and Medicare. And that's a large portion of your paycheck. It's 7.6 or 7.65%, I want to say. And that will be eliminated. So 7.65% tax you don't pay in retirement because you've already paid that tax before. And then some expenses that may be eliminated. You might pay off your house. You might have some cars that will be paid off, although I put an asterisk on that one because you're going to need a car every so often and things happen. Hopefully the kids will be out of the house by then, although kids are living in with their parents for longer and longer, it now seems, because right, it's expensive to live. But those are costs that may be eliminated. And then if you have expenses that will remain, your normal daily living, your food, utilities, gas, etc. And then some expenses might increase if you want to travel anywhere, if you sometimes healthcare might increase. Those are the sometimes that we see, especially in those first 10 years of retirement. You might have expenses that increase. Those next 10 years of retirement, a lot of times your expenses decrease for various reasons. You're just not moving the same. And then maybe at the end of your retirement, that's where expenses might pick back up again due to healthcare. So the total estimated need of your income, you might really, if you look at your income, you might only need about 70 to 80% of what you're making. So let's say your household income is 100,000. You might only need about 70 to 80,000 dollars of income from your for your retirement to live very comfortably, just how you normally are living. If we wanted to dive into the numbers a little bit, some people are analytical, just looking at it from a breakdown. Let's say you have your pre-retirement income on the left is 100%. Your post-retirement income, if you subtract out your savings of 6%, subtract out maybe your changes in lifestyle, 8%, and then your change in taxes, usually your tax bill does go down in retirement because your income's typically less. So factoring those three things in, that's where we get the 70 to 80% of income that you actually need for retirement. And then of that, you can see that Social Security provides maybe a quarter of your retirement income, potentially your 27%. And then the rest of that would come from private sources, right? Your savings in general, 401ks, IRAs, brokerage accounts, that type of thing, just to maintain your style of living. Social Security, very large part of your retirement picture. Funny enough, Social Security was never intended to be a sole source of income for retirement. This was mainly to help older Americans who are maybe disabled, or that had a parent who passed away. That's what Social Security was meant for, right? It's not necessarily recalled, right? It's retirement income, but Social Security for kind of those catastrophic events. But it's become a mainstream source of income for people in retirement. Funny enough, they're talking about right now potentially making changes to Social Security, of course. And we've all of us have heard that Social Security might run out, right? The fund's going to run out in 2033 or whenever that's the projections there. That doesn't necessarily mean Social Security is going away per se. That just means they're going to have to fund it, either raise taxes or potentially cut the Social Security benefit. They might do one or the other or a combination of the both. Social Security will be around. As I mentioned earlier, everyone pays 7.65% of their paycheck into, well, I guess 6.2% into Social Security directly. And then your employer actually also contributes 6.2%. So there's a lot of money flowing into it. Although the actual, right, the fund, the Social Security Trust Fund, I call it, will potentially go to zero in a couple of years. But needless to say, Social Security is likely going to be around. And right now, that monthly benefit on average for 2025 is about $2,000 a month. So $2,000 a month at full retirement age, which provides about $24,000 a year in income. The way it's calculated is they take your top highest 35 earning years, okay? And then they factor in inflation and cost of living adjustments and all this stuff, and they give you this number. So typically, if you are a high earner, the monthly caps you'll see if you've maxed out Social Security every year for your top 35 years, you'd have those respective amounts. At age 70, you actually have $5,000 of Social Security income if you've maxed it out. Now, most people don't get that benefit. So we typically talk about the average monthly benefit of about $2,000. Now, your spouse is entitled up to half of your benefit. We'll talk about that in a moment. But so if you are a family, if you're married, your spouse can take half of your benefit, but they usually have to elect either half of your benefit or their own benefit, whichever one is greater. You can't do both. You usually choose the greater of the two. So if you stayed at home, your life, if you have a husband or wife that stayed at home, they could take up to half of your Social Security. So when to take Social Security? Do you take it at 62, age 67, age 70? Do you wait? This is debated widely, but our consensus at our company is you want to take Social Security basically the year you retire in. Well, you want to take it because you want to use Social Security, right? If you retire at age 62 and you take Social Security, you're going to want to use that benefit for the first 10 years. That's when people travel the most. That's when you're actually going to use it. Now, if you take it at age 62 and you live till you're 90, of course, the math works out. It would be better. You're going to receive a less benefit if you were to take it at 62, rather if you were to wait. Of course, if you live longer, it is better to wait to take it. But here is just how Social Security works. The full retirement age is when you get 100% of your benefit. So that's at age 67 for most people. If you were born in 1960 or after, it can be at 66 and 8 months or 66 and 10 months, depending on when you were born. But probably for most people on the call, it's going to be age 67. That's when you receive your full retirement amount. Also at age 67, that's when you can continue working and receive Social Security and not have a reduction in your Social Security amount. So most people don't know this, but if you're in between age 62 and basically 66, if you take Social Security and you're still working, you'll reach, if your income's over a certain amount, you actually your Social Security goes down. It gets deducted. It does get paid back, but there's really no point if you're in your early 60s, if you're working, it doesn't make a lot of sense to take Social Security then. But again, as I mentioned, I would say a rule of thumb too is if you, let's say, don't have a ton of retirement savings saved up potentially, it's usually better to wait to take Social Security. So if Social Security is going to be your primary source of income for retirement, it's likely better that you do wait until 67, potentially further, if just because you'd want to maximize your dollars for Social Security that way. Now, if you don't rely on Social Security, if you have a lot of assets saved up, oftentimes we would recommend taking it as early as possible because we just simply don't know when you're going to have the bad day, and you really want to use that money early in retirement. So that's when we usually advise for it. Now, I just talked about this. If you collect early and continue to work, once you're 67, the full retirement age, there's no penalty there. You don't get any reduction in the year you reach full retirement age. So if you're in between 66 and 67, if you would give up $1 of your benefit for every $3 you earned above 62,160 for 2025. So again, $3 over that 62,000, you'd get a $1 reduction. So not a huge deal there, but it really is penalizing if you're under full retirement age. So that bottom one there, you would give up $1 in benefit for every $2 you earned above $23,400. So, if you're earning basically $40,000 or more, your Social Security benefit's going to be wiped away if you're under full retirement age. So your monthly benefit amounts, here we go. Let's talk about it here. Oh, I'm going too fast here. Now, the blue line, let's focus on the blue line here, is age 62. If you claim at age 62, you would receive roughly a 30% reduction in your Social Security amount. So that over your lifetime, if you lived until your 90s, of course, that's going to give you the less overall amount. So for someone who has a $1,500 a month Social Security at 62, if they lived into their 90s, you might have $1 million cumulatively that you've gotten from Social Security, but it's going to be lesser than waiting if you were age 66 and age 70. So here are some of the break evens. At age 66, if you decided to wait till 66, the break even versus age 62 would be at age 76. That's when you would actually surpass and have more money coming in from Social Security if you took it at age 66. Now, if you were age 70, if you waited the last day you could take Social Security at age 70, your break even point would be age 81 versus your age 60 versus taking it at age 66. So if you plan to have a long and healthy life, and it might be beneficial for you to wait, but again, our consensus is the earlier you take it, if you can afford to take it early, it usually is what people would like to do. The spousal benefit. So here's how you qualify. Say you've been married. Here is how you would qualify for your benefit as long as you're 62 years old. So you got to reach that minimum age and have been married for 1 year. And also your spouse has to have filed to claim benefits. So for example, if you're trying to claim your spouse's social security, and they have already had to start their Social Security benefit. So if your spouse is 65, already on Social Security, that's when you could potentially like the spousal benefit. Now, keep in mind here, an individual only can choose their spousal benefit or their own benefit. You're going to choose the kind of the greater of the two. And then the spousal benefit is equal up to half of your spouse's Social Security. So that's the maximum you can get. It does tier down. So it might be 40% of your spouse's Social Security. Just the maximum you can get is 50% there. Now, this is a fun slide here. Divorced spouses. Most people want to get back at their spouse. Unfortunately, that's not how the system works if you're a divorced spouse. But if you were married for 10 years or longer and have separated, have been divorced, you can get access to spousal benefits if you qualify, if you're unmarried, of course, if you're both 62 and have been divorced for, at least 2 years. So if you're divorced, again, if you choose the spousal benefit, you can only choose this one time. You'd have to either take the spousal benefit or your own benefit. You don't get the double dip. If you are divorced, you can't take your ex-spouse's benefit or half of that and your own. You get to choose one or the other. And say you chose your spousal benefit and you're divorced, that doesn't reduce your ex-spouse's benefit at all. There's no implication there. You can't get back at them, unfortunately. So keep that in mind that but it also is good to keep in mind that if you've been married for a while, over 10 years, this could be a good option for you, especially if you potentially stayed at home for a large majority of your career and don't have a lot of Social Security credits built up. And then on the right-hand side, you're going to see survivor benefits. So we're going to talk about this next slide. But if you were married for 10 years and say you divorced and your ex-spouse passed away, you could be entitled to survivor benefits. And this is actually a very unique scenario where if you take a survivor benefit, you can take a survivor benefit and then switch later on to your benefit down the line. And we'll talk a little bit about that in a moment. But the survivor benefit has been built for, an extreme circumstance where you have, somebody passed away. And to get this, you have to be at least 60 years old or 50 if you do have a disability. So surviving benefit spouse. So this is different from divorced. Surviving spouse, right? I know you might have survived the marriage, but this is if you survived an ex-spouse. So you can get or receive a step up to the benefit of the spouse who passed away. So if you are married and your spouse passes away, you can receive their entire 100% of that benefit. So that's very good. And that's important to know. You can actually take that at age 60. So we do highly recommend. Most people are not aware of this benefit. Obviously, it doesn't come across our table often, but you can take the survivor benefit and then switch later on to his or her own benefit later on. So this typically is an option that you can do. So switching gears from Social Security, IRAs, your retirement savings, what should you do with your retirement accounts? So say you've got a 401k, you're planning to retire in a year, you have options. You kind of have these three main options. You can roll it to an IRA, you can leave the money within your company's plan, or you could take a lump sum distribution. So depending on your situation, let's say you're going to retire at 55, you might want to leave your money in an employer-sponsored plan because you could take it out penalty-free. Now, I will tell you this, in most cases, if you're going to retire in your 60s at some point, I'd say it's very, very common for most people to do option one is to move their money from a 401k into an IRA, whether that's a traditional IRA or Roth IRA, solely for the fact that it's easier to get your money out. You have access to a wide variety of investment options. There's just a lot more flexibility within the IRA. and you're not subject to the plan rules. So the plan only has a specified amount of investments. There's a couple different reasons there, but basically, most people do roll their money into an IRA just because it's simpler, it's easier to set up your bank like. Lots of strategies there. So within your retirement accounts, how should you invest your money? If you are retiring, most people are like, well, I can't afford to take any risk. I need to reduce my risk as much as possible, right? And yes, that is a great point, but there's various levels of risk. When most people think of risk, they think of losing all of their money. However, in retirement, there's a lot more risk. There's a risk that you could run out of money due to inflation, right? The longevity risk. If you live a really long time and your expenses go up each year due to inflation, well, you don't want to run out of money. That's a bigger risk that people don't think about versus the risk of the volatility in your investments. So this is a great chart just showing some income strategies for retirement. And you'll see at the top here, if you look at the circles, it shows you in different investment allocations. So on the left-hand side, you have 100% stocks, which would be basically the most aggressive portfolio that you could have. And it goes to the right to 100% bonds, which would be probably the most, conservative investment strategy that you might have. And then on the left-hand side, you'll see withdrawal rates. So if you withdraw 4% of your portfolio and 5% and 6%. So if we look at this chart as a whole, what this analyzes is somebody who retires and takes distributions over a 30-year period. So if you retire at age 65 and live till you're 95, what the outcome in your balance would be after those 30 years. What are the percent chances that you could run out of money? And basically, let's take a look at this table here. So if we're looking at if you're in a 100% stock portfolio, the most aggressive portfolio, and withdraw 4% of your account, assuming a 3% increase a year, 100% means you've never run out of money in your accounts, never run out of money. So same thing if you're in a 60% stocks, 40% bonds portfolio, there's never been a time from 1961 to 2021 where you've run out of money, right? 100% chance of never running out, so of success. And then as you can go, the more conservative you go, there's actually been a time withdrawing 4% of your money where you have run out of money in the most conservative portfolio. And then if we take a step down, if we look at the 5% rate, if you withdraw 5% of your portfolio, there's never been a time, right? If you've been in the most aggressive portfolio where you've run out of money. And then once we get to 6%, that's where you start to see there's been historical periods of time where people have run out of money, withdrawing 6%. Although what I think is what's interesting is even the most aggressive portfolios actually give you the best chance of never running out of money. So they reduce your longevity risk here. Now, there's certainly, being in a 100% stock portfolio can certainly create risk in the short term. There is something called sequencing risk, where if there was a big recession in the year you retire, that's the worst time you could experience a recession. So it's not always prudent to be in the most aggressive portfolio leading up to retirement. But what this does tell us is that having stocks can feel risky at times, but it actually reduces that longevity risk, which is one of the bigger risks that we feel like people endure in portfolios, especially during retirement. Now let's take a look at historical market crashes. So if you have a large portion of your accounts in the stock market, as long as it's diversified, here's the history of the market crashes dating back to 1945. So we've experienced over about 20 of these crashes that have been about 20% or more. And here's the history and here's the averages behind it. So on average, the market out of all these 20 or so have gone down about 28.6%. And it takes about 10 months from the market to top to go all the way to the bottom, to go down 28% on average. It's gone down 28%. It's taken 10 months. And then it's taken 13 months for your money to recover. So on average, if you were to go from the top down to the bottom, back up to the top, it takes about 2 years on average. Now, there's been periods of time where it's taken longer than that. You'll see 08, 09 on this graph. That took about 40 or 50 months overall. So about 4 years for the market to go top, back down to the bottom, back up to the top. So you do have to plan for that. So how do you position your portfolio for this? So if you were in 100% stocks in 08, 09, that likely would have created some issues for you. So there's ways to protect your portfolio by not being 100% stocks, but we just wanted to show you that market crashes, although they happen pretty frequently, and you will likely experience them in your retirement, you just will. They don't happen forever, right? 10 months might feel like a long time on the way down, but then it does pop back up very quickly. So again, we just want to reiterate, don't sell. This is all a part of history. We've seen it before. And usually you want to stick to your investment process. So investing through the big drops, how does one overcome a significant market drop? Focus on the long-term averages, right? It takes 13 months for the market to recover. If you see on the news where the market's down 20% or 25, 30%, usually the news is very backward looking, right? That's already happened. If the market's down and your account's down, it's likely just a matter of time, at least historically, till the market starts to recover, right? The panic has already set in. And what people don't tell you about it, the best days in the stock market have always happened right after the worst days. So if we have a very bad day or bad week or bad month, typically we have very, very good days and good weeks and good months that precede that. So don't sell from your stocks. If anything, if you have some safety built into your portfolio, and we do have experience a severe recession, this is when you'd want to spend from your conservative accounts, your bonds, your money markets, your cash. Don't touch your stocks. Let that recover and spend from your more conservative portfolios. So healthcare, switching back to healthcare, Everhart, we are not Medicare experts and we're not licensed in the healthcare space, but we can provide decent options and we can provide maybe not exact advice, but just general guidance here. A couple options when you're retiring. What healthcare do you choose? If you are retiring prior to 65, if you are in your 60s, 50s, looking at the healthcare.gov, if you go to the ACA, Affordable Care Act, this is probably going to be your best option to find affordable healthcare. And yes, affordable healthcare, it's kind of an oxymoron. It's very, very expensive in general, but the ACA does provide federal tax credits. So if you qualify for maybe not federal tax credits, but you get deduction in your healthcare premiums if your income's under a certain threshold. So even if your income, let's say, is 80,000, you typically do qualify for healthcare credits that can deduct your premiums. Of course, if you're going to retire, these premiums might be thousands of dollars a month, usually 1,000 or more potentially. But if your income's low enough, then you can qualify for a lot of these credits and make it very, very affordable. So that's if you're under 65. Once you turn 65, there's a couple things. Well, you'd want to, if you're still working, just maintain your group coverage more than likely. But if you're not working at 65, this is like when Medicare is kind of a no-brainer. So usually you'd want to apply for Medicare about 3 months in advance. So thinking about retiring, still working, schedule your Medicare appointments about 3 months in advance. And then long-term care insurance at the bottom, we're very not anti-insurance. You need to insure the things that are insurable and like the big things in life, like your home, your life. Healthcare would be one of them. Now, if you can self-insure, if you have enough assets that you can afford those long-term care, potentially down the line, probably doesn't make sense to buy long-term care insurance. There are certain assets and income levels where long-term care insurance could make sense, but that's very niche area right there. So if you want to talk about Medicare or private coverage, We do have a great resource. This company, Retirement IQ, they have raving reviews. We send a lot of our clients here to talk about health insurance. Here's their contact info. We recommend setting up a meeting. Kevin Loudon over there has been super great, and this would be the way to navigate the health insurance landscape. Now, if you're in an area right now and you want to improve your retirement outcomes, say you've gone through your projections, say you're not happy with your plan, say you've or endured just life expenses and weren't able to save how you wanted to during your working careers, here are just some ways that you can improve. One, contribute more, right? If you are very passionate about retirement, lock in, right? Save more. There are enhanced catch-up contributions that you can make towards retirement plans and health savings accounts. So, for example, in retirement plans, you can actually contribute 8,000 more dollars to 401ks or 403bs. So you could put in up to $32,500 for 2026 into these retirement plans. If you're in between 60 and 63, it actually jumps up to like 35,750. For IRAs, you can put in 1,000 more dollars up from, I think it's 7,500, it might be 8,500 this upcoming year. Health savings accounts, you can of course put in about 9,300 for 2025. Brokerage accounts, there's no limit. So if you have money sitting in a bank account and it's maybe in a CD or it's in a high yield savings account and you've been seeing those rates drop recently, a brokerage account could be your fix. So this is an account that you can open up. We can help you open up outside of the 401ks, but you can do it with Schwab or Fidelity. There's lots of different brokerage account providers out there, but you can move in $100,000 or $200,000 into these and start investing in stocks and bonds. You can have more growth, more safety. There's high yield accounts. So brokerage accounts are a very valuable account that you can have that kind of looks like your retirement accounts, the way you invest it, but you can have access to it anytime. The second would be to delay retirement, right? If you say don't have a lot saved up, you're going to rely a lot on Social Security. So you might want to wait until you are 68 or 69 or 70 to take Social Security if that's going to be a very big part of your income. You do get an 8% increase in your Social Security if you do wait. And then consider part-time work. Like I mentioned earlier, if you like golfing or grocery shopping, right? Work at a grocery store. Do something part-time that's not too heavy on you, but could be fun. Could make a few friends. And then 4 is adjust your investment allocation. So this would be the last thing that you could do is look at your investments, look at your entire picture, focus in on, do you have enough growth? Do you have enough safety built in? Where are the areas that you could improve and optimize your plan? Last few slides here. So some action steps. I showed this earlier, but I'm going to touch base on it again. If you feel called to create a retirement plan or just to have somebody review to see if you could retire at 65 or 67, contact one of the advisors at Everhart. Contact myself if I'm your workplace financial advisor or Max or Phil, you name it. We'd be happy to help you do that because it's complicated to identify the sources of income. How much can your investments, how much income can your investments produce? Figuring out a budget, we can do all that. Social Security analysis, we can link you up with Medicare consult. So anything in terms of retirement, if you feel called, please set up a meeting with us. We've got my QR code down at the bottom if you wanted to meet with me directly. If you wanted to meet with your own advisor, hopefully you have his or her contact information. Or if you just like to set up a time to meet and chat, our help at everhartadvisors.com email right at the bottom here is a great way to get a hold of us. That is by far and away the easiest way to set up a time, or scanning our QR code, of course. And before I get to questions, you can type them in the chat box right now, and I will look at them. If I don't get to all the questions today, I will follow back up with you. This session is being recorded, and if you leave your email in the question, I can definitely follow back up one-on-one. Last thing before we get to questions, our 2026 calendar is now out, focusing on a wide variety of topics. Every month we have something new. If you visit our website, everhardadvisors.com/EAU hub, you can get access and sign up, of course, for free to review these webinars. We've got some new topics coming up. We talk about interest rates and the effects of home purchases in February. I'm going to be doing that one. So that'll be a great session. Of course, we talk about a lot of the stuff we've talked about this year, but we've added in a few different topics here. So on your own time, go out and review the 2026 calendar. So now I'm going to go back. Let's review some questions in the chat box here. Okay. We do. All right. Here we go. The first one was, I think you're muted. That just gave me a heart attack. That was at 10:01 a.m. But they set up, and that was my computer. So luckily enough, I think I was not muted. So that is good. Can we get the slides? Yes, these slides will be emailed out to you tomorrow. They do have to be approved by compliance before they are sent out. So be a little patient on that, and then they'll be sent out. We have a question here on healthcare. Okay, is there anything apart from healthcare exchanges for healthcare coverage pre-65? Well, yes, you have Cobra. You could do Cobra, which essentially it extends your group coverage that you currently have with your employer. It extends it for 18 months. Now, the thing with Cobra, it tends to be more expensive. However, if you can afford it and it won't be disruptive to your healthcare, right? You can go to the same networks, the same doctors, same providers. So Cobra is the other benefit that was on the slides. I didn't touch on it, but that would be the other option pre-65. Other than that, the ACA marketplace is your best option. Right. Okay. So we've got lots of questions coming in. It's messing with my system here. Okay. Is Social Security spousal benefit on full retirement age at 65 only, or will it be at age 70 Social Security rate? So the spousal benefit is at a maximum 50% of the spousal benefit. So 50% of whatever your spouse had. And you could take it at age 62, but if you take it at age 62, you only get like 37% of that benefit. If you wait till 70, that's when you get the 50% of the spousal benefit. So that's how that would work. It's again kind of a complex complication there, but maximum you can get is 50%. On the low end, it's like 37%. All right, copy of the presentation. Yep, we're sending that out. What's the retirement plan for someone who's 40? So if you're 40, great question. I did gear a lot of this to somebody who's approaching retirement, but if you're 40, there's a lot of factors that go into it, but there's a few softwares that we can have that can simply project out your retirement that would say, okay, here's what you're saving now at age 40. Hopefully you're saving roughly 10% of your income as a total. If you could save 10% for the next 25 years at age 65, you're likely going to have a lot of money, but we can run that projection, determine what your balance will be, and then of your retirement balance, we can figure out how much monthly income that will provide you. Okay, I am 66 and I'm now told there will be some kind of penalty for not signing up at age 65. I assume that's referring to Medicare. Now, Ian, so the Medicare question is it depends on the plan you have. Sometimes you don't have to sign up for Medicare at age 65. It does depend on your health plan. So what I would recommend there, go to your HR director, figure out that would be a question for them. They should know that if you're still working, depending on your healthcare plan, if you had to sign up or not. Do you have any recommendations for brokerage accounts to set up for investments? So our company, if you decide to work with one of the advisors here, we work with either Charles Schwab or a company called SEI. So we could help you open up a brokerage account. Outside of that, I know many people prefer Fidelity or Charles Schwab. Also, you could do that independently, or Vanguard. So those are a few of the other options for brokerage accounts. If you email me, I can give you some recommendations there. Okay, talking about Medicare. Okay, perfect. If I retired at 63 to do an IRA with my 401k, how soon would it be before you can borrow from it? All right. If I retired at 63, should do an IRA within my 401k. So, if you retired at 63, so if you're retired and you actually are not eligible to borrow from any 401k, or that you can't borrow from an IRA either. So that's when you would just have to take distributions out from those accounts. So if you're retired, you just take distributions. You can't borrow from, you can't pay yourself back from those accounts. Now, from a brokerage account, like I was talking about, there's actually ways you can borrow from it, but that is a topic for another time. All right, a couple more questions. 10:51. We got a little bit of time here, so we got great questions rolling in. Hopefully I didn't miss any. Let me just take a look. Oh, I did miss a few, so let me go back here. Starting. Okay. So starting Social Security, I'm worried about making over the 24,480. Is a 401k a good place to lower income? Yes, it would be. You can, defer money into the 401k, and that would lower your income. So that would help lower your income overall. Yes, is the answer to Paul. Here we go. See if I missed any more. All right. My spouse retired at age 62. I plan to work until 70. At the time, 50% of my benefit would be more than my spouse's benefit. Can my spouse switch to spousal benefit when I retire? The answer is no. Once you elect a spousal benefit, that's when you're locked in for life. Once you choose your Social Security, if it's spousal or if it's your own, that's when you're locked in. You don't have any flexibility there. The only time when you can switch is if your spouse or ex-spouse passed away. That's when you can take the survivor benefit, which is slightly different. Can I set up an IRA at 50, or is that a certain age? Yeah, you can set up an IRA at any time, Roth IRA at any time. You just have to have earned income to contribute to those accounts. Also important to note, sometimes they have income restrictions. So if you're contributing to a retirement plan like 401k, there's income limitations there. So just be careful. Talk to someone before you were to open up an IRA, just so you know the rules behind that. All right. Is there a penalty if you retire at 63 and take distribution from your IRA? The answer is no. Once you're 59 and a half, you can withdraw your money out from an IRA penalty free at any time. All right. All right. Well, I think for the most part, that is just about every question. I will leave this up one more time just for a moment. If you did want to follow up with us, schedule a meeting, here is our contact information. So I just want to appreciate everyone for hopping on today, and I hope everyone has a Merry Christmas. Get your Christmas shopping done. Those last minute people, I know you guys probably like the thrill of it, but Go get that done and enjoy the holidays. Stay safe, and we'll see you soon.